what is your assessment based on the data that you've seen as to what is the strength of consumption in the Indian economy?
Look, I mean, the more than many of the high frequency indicators, I do take a look at the RBI's forward-looking surveys that they come up with before their monetary policy meeting, and there the picture is clearly subdued. And in fact, I was just going through the business expectations of inflation, which IIM Ahmedabad has been producing, and there, if you look at the corporate sector's feedback, they do say that demand is subdued, and of course, this reflects January information, and you are seeing in February and March, if you look at the airports, they are quite busy and traffic is quite brisk. So, however, before we could all breathe a sigh of relief about Omicron having been somewhat mild, then this big shock had come about, the oil price shock, etc. So my feeling is that the first half of the next financial year would still see subdued consumption growth, because there will be at the back of the people's minds the fear of a recurrence of the pandemic because of what is going on elsewhere in the world. Will we get another wave or another variant? So I think until the cloud of the pandemic lifts over our heads, I think consumption recovery would remain restrained, and that would in turn have knock-on effects of the timing of the capital expenditure expansion plans by the private sector.
I'll get to that in a minute. There is then a concern that so if consumption is weak, private investment at current capacity utilization levels will probably not pick up. There is the government spending, of course, that's coming up, which will hopefully spur some activity. Exports was supposed to be a lever. I don't know how it plays out now. Could we hit into stagflationary-like conditions? I know India will never see stagflation in the Western
exactly, because
context.
I think different people have different personal understanding of the word
exactly.
stagflation. No, you are right. See, government capex, as we all know, have been widely discussed since the budget was tabled, is definitely doing the role it is supposed to be doing, which is to sort of keep the underlying investments going and creating the basic platform on which private capex can take over. I just want to highlight one point about your comment about the capacity utilization. That is true. On average, capacity utilization levels are not at a point where they would require additional capacities. I agree with that. But if you really look at the top 4 companies in different sectors, their capacity utilization levels are much higher. Sector as a whole, and both steel, cement, I forget the other two, definitely steel and cement and some chemical industries, I noticed that the capex capacity utilization of the top enterprises are above 75 to 80%. And that is what we saw. I mean, from your BloombergQuint itself, I saw many of the capital goods equipment companies are witnessing very brisk offtake in their orders, etc. That's a very strong indirect indicator that some companies are looking to expand capacity, notwithstanding the average numbers. But I think the truth is, yes, you have to wait for at least a quarter or two before private sector really begins to invest. And exports, you are right, it all depends on the global economy and the demand that is coming from there. So we had a great run in 21-22, but that's a great silver lining. However, I agree that uncertainties have increased. So the question is, are we going to have a stagflation light, as you put it? I think, stagnation in the growth rate at what level is the question mark. I mean, most people assume that stagflation means economic stagnation plus high inflation, and which means the economy comes to a sort of a standstill. Growth rate doesn't pick up, the economy stands still. That is a stagflation. So in our case, it is not about stagnation at all, because growth will be happening. There is going to be a positive delta. The question is whether it is the 8.9 or 9%.
How far below potential it is.
How far below? The potential, of course, is another gray area.
Yes, I know.
Potential could be anywhere between 6 and 7%, and it could even pick up to 8% few years down the road. But right now, you could say potential is 6 to 7. Private sector forecasts are coming down from double-digit levels down to 8 and 9. Somebody even coming up at 7.5 and so on. So it's right now, it's very difficult to sort of put a precise number and say, this is the range within which the GDP growth would converge for 22-23. I would at the moment think that 6.5 to 7 or 6.5 to 7.5 still looks, in terms of real GDP growth, is still feasible for the year 22-23. Okay. and the budget itself assumed the nominal GDP growth of only about 11.1%, which gives a very good buffer. And if, as we discussed earlier in the conversation, if the oil price elevated levels do not last for too long, I think those assumptions would hold.
What is your perspective on inflation?
Obviously, the numbers will be anywhere between 5 and 6, depending on the extent of again the same answer, pass through, the persistence of the oil price and the pass through, etc. So I think we are going to be sort of flirting with the upper end of the range of 2 to 6%. And it's not only oil; we also have to watch out for food prices, etc. So it is going to be a challenge managing inflation and the growth concerns that we have. So,
but we won't send a message that we are easing up on our very recent inflation focus if we don't act when we are closer to the upper band.
Well, I think that is a decision for the RBI to make. I don't want to comment on that.
Sir, in a blue sky scenario, and we talked about a lot of the risk, I think what was happening at the beginning of this year was that it was finally clear that the twill balance sheet problem is out of our system broadly, right? Mm-hmm. Large corporates had deleveraged, banks were cleaner.
Yeah.
So potentially, if this government capex play goes as planned, we could get a solid investment cycle?
I think so, because we did all the hard work in the last decade. I mean, the first decade was a capex and lending boom. Second decade was retrenchment and reversion to the mean. And the third decade should have seen a sort of a recovery. But then came the pandemic, and then now the new uncertainties, etc. But hopefully, I mean, if we talk of a decade, you still have about 8 years to go. I think if these conditions do settle, I do expect a private sector investment recovery, as well as bank credit growth rate to recover as well. So that is why I am quite clear in my mind that, notwithstanding the current uncertainties we are facing, our economic glass is more than half full.
The issue here again is only of timing, perhaps. And,
yes, I agree with you. I'll concede that the timing has become more rather than less uncertain in the last several weeks. But I still think we are talking about a decade, that is 8 years away, 8 years out. There is still room for the current set of concerns to recede.